Dear all, MeDirect thanks you for joining this webinar, the fourth in our MeDirect Talk series, where we aim to introduce you to financial experts and asset managers so that they share their views on the financial markets and investment opportunities. This webinar is aimed at providing you with information on how investing in a portfolio of infrastructure companies can give you sustainable income whilst giving the world sustainable growth. MeDirect has always been at the forefront of providing you with the latest on the investment world, and we aim to continue doing so through our regular updates on our website and social media accounts. Our team of experienced wealth advisors are always available to assist you. Franklin Templeton, one of the biggest fund managers in the world, has joined us for today's webinar. We will be discussing the reasons why infrastructure is deemed to be the critical lifeblood of the world, and why it is a mega trend that will shape our children's lives over decades. More infrastructure spending is being committed to by the big nations, and as they continue to develop, clearly such infrastructure projects require funding. Our renowned guest speaker will also be discussing the current trends around ESG, environmental, social, and corporate governance factors that measure the sustainability and societal impact of an investment in a company or business. I will leave you now in the good hands of our speakers. David Chambers will be giving you a very brief introduction of today's presentation. He will then be followed by Ajay, who will be discussing infrastructure assets, why they are needed, and how you can access such investments. David, over to you.
Thank you very much, Ingrid. And as Ingrid has said, my name is David Chambers, and I am a Business Development Director at Franklin Templeton. And I will provide you with a brief introduction to this evening's event. Franklin Templeton are delighted to be working with MeDirect on this presentation, and we are coming to you at an extremely exciting time in the history of our firm. I'm delighted to tell you that at the end of July this year, we completed the acquisition of a fund management group called Legg. This is one of the largest ever deals that has been completed in the history of the asset management business, and we are now the sixth largest active asset management company in the world, with over 1.4 trillion of assets under management. And we have over 12,000 employees throughout the globe. It also brings about a wealth of additional investment capabilities for clients of Franklin Templeton, and we are extremely excited about the opportunities of maximizing the combined talents of each company for the 1.4 trillion of investments that people like you have entrusted us to manage on their behalf. One of the opportunities we are particularly excited about is investing in infrastructure companies. These are companies that are investing billions of euro to improve our daily lives for generations to come, improving our roads, our airports, seaports, train services, communication networks, and the water and electricity we use every day are just a few examples of this. And that is the subject of this evening's presentation, which is entitled, Investing in a Portfolio of Infrastructure Companies Can Provide Sustainable Income and Give the World Sustainable Growth. And to discuss this, I'm delighted to introduce you to my colleague, Ajay Dayal. Ajay is an investment director and head of equity in our product specialist group at Franklin Templeton. He is an extremely talented investment professional with over 20 years experience. He joined the company in 2008 and works very closely with a number of our specialized investment managers, and he has represented us at conferences throughout the world. Over the next 45 minutes, Ajay will discuss 5 key areas of investing in infrastructure, which Ingrid has highlighted, but I will repeat. Number 1, why infrastructure is the critical lifeblood of the world, and why it is a mega trend that will shape our lives and our children's lives over decades to come. Number 2, why even more infrastructure spending is being committed by the nations of the world but also why they need our help. Environment, social, and governance aspects of investment is not a fashion. It's here to stay. And understanding how government policymakers and investors think is critical to future returns. Number 4, what are the benefits of an infrastructure and how can an investor access these companies? And finally, why a smart portfolio of infrastructure stocks can provide you with a stable, sustainable, and attractive income, as well as potential capital growth. So before I hand you over to Ajay, you will see the presentation on your screen. If you would like to make the slides bigger, you can click on the icon with the 4 arrows at the top right of your screen. Thank you very much. And Ajay, over to you. Thank you.
Great. And thank you, David, for the introduction, and Ingrid for your initial start. Yes, so the topic for today is investing in a portfolio of infrastructure companies that can provide sustainable income and give the world sustainable. We think listed infrastructure. Why do I say listed? It means companies that you can buy on stock markets, buy shares in stock markets around the world. These are infrastructure companies that are high quality, large companies that you can buy from around the world that give you access to these amazing megatrends that are shaping our world today. These megatrends are going to shape our careers, our lives overall, but they are also going to shape our children's lives. And I'm going to explain why. So moving on. So why listed? But what is an infrastructure asset, first of all, right? So when we think about infrastructure, people say, so Ajay, what is that? What is an infrastructure asset? Does it mean utilities? Does it mean power grids? Does it mean electricity lines? Does it mean airports? And all of those things are, in many ways, infrastructure. David mentioned this right at the beginning. We are looking, when we think about infrastructure, we think about essential services, essential facilities. What are the things that you and I both need to sustain our lives, right? From the time you wake up in the morning and you have that shower where you need water and electricity or gas to heat that water system, to having breakfast and cooking breakfast in the morning, which is electricity or gas, to going to work in a normal world where we do actually go to work, and taking public transport or taking your car where you need fuel or you need transport or a public transport system. These are all parts of our natural fabric. And when we get to the office, we want potentially infrastructure links through satellite links, through communication networks, so that we can undertake our work. Our children who are at school need infrastructure to get to school. They need infrastructure when they're at school to have facilities. For example, they could have water systems. They need to have catering facilities in terms of who provides it, how does it get to their school. So you think about transport systems. So in many ways, infrastructure is a large concept in the sense of it is things that surround us every day. These are the most essential services that we need in our lives. So I'm talking about investing in companies that do this well, that are very long-term in nature, and importantly, often have a monopoly status. Now, I know many of you who are on this call today are business people. And as you know, if you have a monopoly power, it means that you have pricing power. It means you have capability to control the demand-supply dynamics to a certain extent. We love companies with monopoly-type power. Why? Because it means they have pricing power to a certain extent. They can build something for the long-term future, and they could maybe have some sort of confidence that they're going to earn a revenue from that asset, from providing that service in the future. So keep it simple. When a water company in Malta is created, if a new water company is created because they believe that certain services are needed by certain parts of the population, how would that occur? How would that water company be created? What services would they need to provide? Would it be water to the house, to the apartment complexes, to schools, to factories? Those pipes would be necessary. And then when you think about it at the next level, it's then saying, and then how do you charge for those assets? How do you charge over a long period of time? Maybe the Maltese government, maybe the regulator works with the water company to say, what is a fair price to charge over long periods of time? Now, this is an interesting concept because, again, many of you probably think that in the world of utility companies, people who provide us electricity, gas, or water, which are often regulated, regulation for the investor is probably a bad thing. For the consumer like you and me, it's probably a good thing. It means we're not overcharged. But surely regulation isn't a great thing for the company that provides it because it means they have a certain maximum that they can earn. And to a certain extent, that's true. But to a certain extent, that's not true. What does regulation give you? It gives you predictability of how much money you can make in the future. It gives you earnings ability in the future. If a government or a regulator says to a water company, to an electricity company, you can make a certain amount of money and you can charge a certain amount to the population over a long period of time, that gives predictability. And with predictability, you have certainty. And with certainty, you have visibility of cash flow, visibility of earnings, which allows companies to grow their businesses, create more assets, more infrastructure, because they feel and they can feel confident that they're going to get paid for those investments in the long time. So going back to this page, what is infrastructure? Well, utilities, we call it the electricity, gas, and water businesses. In simple terms, think of poles, think of wires, think of pipes, the things that come to your house, come to the factory, come to your office, come to the school, the simple basics, right? We're not necessarily interested in the companies that create the power. We're interested in who owns the wires, the pipes, the poles. Who owns that fabric of infrastructure? How does the electricity grid come to your house, right? Who owns the electricity grid? And in some parts of the world, it's owned by the government. But in some parts of the world, it's not. It's private. You can invest in it because they are publicly owned companies on the stock market, which means that if we feel that these are high quality, high grade companies, we can invest in them. And the best thing about these companies is they're not often, you don't find replacement companies for a company that's providing, for example, the national grid network of the UK. Once the grid is in the ground above you, you don't find new companies trying to compete. Those assets are going to be there for 20, 30, 40 years. And they're going to be able to earn an amount of money from those assets over that period of time. So we often look at these kind of companies that provide these infrastructure facilities, these essential services, as being quite defensive. Why defensive? Because it doesn't really matter if the stock markets go up and down, if economies go up and down. When you think about it, if an economy goes up and down in terms of success, boom period, recession period, do you drink less water? Do you shower less? Right? Not generally, right? So if that's the case, the earnings and the revenue of many of these companies is very stable. We like businesses which have what we call asset-based regulation. Based on the amount of assets that they have, they can earn a certain amount of money. And so these companies are less sensitive to economies going up and down. They're more stable, more defensive. And often they pay a very attractive income for investors because they recognize they're quite stable, mature businesses, paying a little bit of income to keep investors engaged. And as David mentioned right at the beginning, as did Ingrid, infrastructure is also a very good source for income. What other types of infrastructure assets are there? The next set is what we call the economically sensitive assets. As economies grow, populations grow, urban centers, cities grow, they grow. So think about railway systems, toll roads, airports, even pipelines. What are pipelines? Like gas pipelines, for example, water pipelines. Why? Because as more cities are created, bigger cities are created, you obviously need to get things to those houses, to those factories, to those offices. Now, these companies often get paid based on what we call a concession system, concession-based contract. So, for example, a toll road company may go to their government and say, I would like to create a road I would love to have a concession for 40 or 50 years. I will build the road. I will take the risks of building that road, right? But I would like to be able to charge this amount over a period of time. And that becomes a concession contract. The government allows it, negotiates what kind of fees they can earn over time. Now, the beauty of that is, although it's not regulated specifically, it's in the contract that they can earn a certain amount of money over a certain period of time. And the good thing for the companies that provide that infrastructure, i.e. the company that owns the toll road, owns the airport, owns the seaport, they can usually have inflation pricing. They can, within their pricing, they can say that each and every year, every 2 years, we can increase the price in line with inflation, which means many of these assets that these companies own, right? Whenever I say asset, think about the hard asset. Think about the road. Think about the railway. Think about the airport. Think about electricity towers. Think about water pipes, sewer systems, dams. So whenever I use the phrase hard assets, I mean what is physically you can kick and see, right? And these companies will make money based on the hard assets they own, and they manage and service over time. So these companies, though, may have a link, a gentle link, to how much you use them. So if you think about an airport, every person who goes to an airport pays generally an airport tax, an airport levy. And in different countries and different cities, these amounts are slightly higher or lower. If anybody's ever flown to London Heathrow Airport, one of the world's most expensive airport taxis in the world, right? That's how they make their money. But they also make their money by charging retailers to operate in their airport, and they make margin that way as well. Now, airports, long-term, have been a very good business, and they will continue to be when this COVID situation is resolved, the world starts to get back to normality and good health, a vaccination is created, and people start to travel again. And maybe they're going to travel a bit less. Maybe business travelers are going to travel a bit less. But the world is getting bigger. The population in the world today is close to 7 billion people. By 2050, which is in 30 years' time, the population is expected to be 10 billion people, nearly a 50% rise. More people means more services, more demands for all of these things: water, electricity, gas, more roads, more railway systems, more airports, more traffic. So even if you feel like there's going to be changes that are necessary in these different businesses, that's true. But you think long term. Whenever we think about infrastructure companies, we don't think about what's happening in the next 2 or 3 years. We think what's going to happen at least in the next 10, 20, 30 years with these companies. Who are they servicing? Who are they looking after? Who are they providing essential services for? So these companies can often have a gentle link to volume. If more people are using the airport, they make more money. If less people are using the airport, they make less money. And so you do see variations, even in public transport systems. But the beauty of these kind of assets is, as the world grows, populations grow, urban centers grow, cities grow, more of these assets are created and they make more money. So they have a nice linkage to the growth of the economy, the growth of the world. So I wanted to spend a bit of time with that because it's really important to understand what is infrastructure first of all, before I tell you about all the other things that are happening as infrastructure. So let's move on. The next slide says, what will drive infrastructure spending, right? Why do I think there are certain megatrends in the world that are changing the way we are behaving, but also are going to be an incredible catalyst for more infrastructure, right? I've mentioned one. Very simply, the world's population is getting bigger, right? The world's population is getting bigger. And you might say, AJ, how often do you see these kind of big population increases, right? The changes that we're going to see in the next 30 years are unprecedented. One of the things you've got to realize, one of the many things that you realize about populations, and I'm a bit of a geek when it comes to kind of population data, right? But there are more people alive today than have ever lived in existence in history, right? So when you think about 7 billion people today, that is more people who've lived in existence since humanity occurred, right? Now you might say, well, how is that possible? Because of aging profile, and the world has exploded in population sizes. Think in the next 30 years, we're going to go from 7 to 10 billion. So infrastructure spending is going to happen from multiple sources. In the developed world, what this slide is about, what's going to drive infrastructure spending? Populations are not really growing, right, in the developed world. This kind of phrase, like the Western states, populations are not really growing that dramatic in France or in Spain or in Italy or in Switzerland, right? In certain developed countries like the US, they're still growing quite rapidly. But there are many European countries where populations are stagnant or growing at a very small rate. But what is happening in those countries? What are they doing on infrastructure? Well, they are replacing old infrastructure. Think about the US, right? A lot of the water infrastructure, just to use an example, a lot of the water infrastructure that was created in the US happened after the Great Depression. In the late 1920s and in the 1930s, right? FDR, the president at the time, pushed, right, the New Deal concepts, the New Deal, that they were going to bring more people to employment and they were going to build the infrastructure to the country. More people employed, more infrastructure to keep them busy. But in the doing so, creating a more productive, better economy, right? Who doesn't like better infrastructure? Who doesn't like a nicer road to drive on, better public transport systems, right? So society, as they've developed, wanted more, and they financed a lot of good infrastructure in the 1920s and 30s in the US. But guess what? They stopped really developing it. And for nearly some of that infrastructure in the US, some of the water facilities in the US, in California, are almost 90 years old. They are creaking. They're literally not fit to deliver to their much larger populations. So what is happening now? The water companies in the US are starting to consolidate. They're starting to come together because they realize they need critical mass. They need the ability to generate more capital from the markets, through the bond market, or through equity investors like us. And they raise that capital to build more infrastructure, to service the needs of the people. That infrastructure spending is happening at a rapid rate. Think about what's also happening now. What's changing today that's changing our landscape? What's changing the landscape? And a big part of that is electricity supply, electricity efficiency. This chart, you can see these kind of little wind turbines on your screen here in the middle of the screen. The great movement of moving away from oil production into wind power, solar power, hydro, right? So this whole idea of renewable energy, right, green energy, has been a dramatic force. Countries around the world, developed and developing, are saying, we don't want to burn carbon. We don't want to burn oil and gas if we can help it. We want a much cleaner energy source. So countries around the world are spending trillions of dollars, right? This is research from one of the big research institutes saying from 2018 to 2040, there's going to be at least $20 trillion in just improving electricity supply by countries around the world. These are enormous numbers. And by the way, this was before the COVID slowdown. This was before Donald Trump and Joe Biden started talking about infrastructure. This is before Europe started to say we need to invest more in infrastructure. This is before China says we needed to do more on green and energy. So these numbers are actually conservative. They're going to be much higher than this longer term. Think about what else is happening. Network and storage. A few days ago, you had the whole announcement by the Tesla organization, Elon Musk, about Battery Day. What was Battery Day about? About how to create batteries that can store more electricity, not just for electric vehicles, but potentially store electricity for the grid, right? One of the things that we cannot do as society is we can create electricity, we cannot store a lot of it. Right? It dissipates. Once you've created it, you've got to literally use it. You've got to send it out, electricity supply. You only have a certain amount of capacity that you can store, and it degrades very quickly. So if you can create battery that can take the excess supply in different parts of the world And you might think, well, how does that work? Well, if you have solar panels, you only generate electricity when the sun is up. When the sun is down, you don't generate electricity, but you might still need energy during the night. So therefore, if you can store the energy in batteries and then release it during the night, you can smooth out your energy supply, right? So these are amazing changes that are happening to the world. And with the advancement of technology, you have the advancement of more and more investment needed to be able to take that technology, invest in it, so they can supply us with more infrastructure, right? More supply of energy. The last example at the bottom is by passenger travel. And this was obviously pre-COVID, but this number of 144% increase, if you think people already travel to Malta a lot, get ready, right? I mean, I was telling investors the last time I was in Malta, pre-COVID, when I came over in 2019, that the numbers for passenger travel are only going to increase. There is a voracious appetite from people, the new middle class, from Asia, from emerging markets, from Latin America, to see the world, to travel. You're going to see more of it in Malta, right? So the airports are going to get bigger. There's going to be more people traveling. Maybe a bit less business passengers, as we mentioned, but people's appetites, as we saw in the summer, people still want to travel, right? And so the numbers, again, are quite enormous. So I hope that gives you a little bit of understanding that today's world, especially in developed markets, is about growing infrastructure, right? From the things that we already use and making it better, more efficient, and also from the things that we think is pretty stable, like passenger travel, but is actually growing at a phenomenal rate over the next 20 years. And then what's happening in the developing world, the emerging markets? Now, I apologize, this looks like a really busy, colorful slide, but what's it trying to show you? It's saying, what this chart is trying to show you is the big urban centers, the big cities of the world, right? This is a map of the world. And each of those red dots represents countries, cities with more than 10 million people, right? The orange dots are those between 5 and 10 million people. Now, the key point to take away from this, there's a lot of red dots developing. And in the next 10 years, we're going to increase the number of megacities, those ones with over 10 million people, to 43. So a couple of years ago, when we did this research from an academic think tank, there was only 33. That's still a lot. 33 cities in the world that had more than a population of 10 million. In the next 10 years, that's going to jump by another 10 megacities. And then think about all the kind of large cities between 5 and 10 million. So when you think about urban populations growing, it's happening. People are moving away from, and they're clustering more and more into cities. So that's going to create infrastructure demand, more transport systems, more healthcare systems, more network systems, right? More water systems, more grid systems. All of this has to be created as a city gets bigger and bigger and bigger. These are incredibly powerful forces, right? Short-term disruptions like COVID, although massively influential to the world today and tragic in many ways in terms of the human cost, these are blips in the long-term landscape of how the world is changing because populations are growing, urban centers are growing, and this is going to drive the demand for more infrastructure. So what else is driving it? What else is creating the world to kind of say, scratch their heads about infrastructure and saying, what else is driving this future infrastructure demand? And it's the things that I mentioned a couple of times already, the Green Deal. Now, you may have heard about this phrase, you may not, but some people call it the New Deal on infrastructure, some people call it the Green New Deal. But it's a reference to this concept of what happened in the 1920s and 30s, both in Europe and in America, as they built a lot of infrastructure to keep people, give them jobs. Now, you can imagine with all the people who are losing their jobs all over the world, governments are keen to increase labor as well. How do we give them something to do and create employment, right? And so, for example, this is an example of an idea that is called the US Green New Deal. This is a government-sponsored idea, right? It's not been enacted absolutely because they're waiting for the elections, and it could be changed depending who wins, Donald Trump or Joe Biden. But basically, both parties are going to spend enormous amount of money, right? Donald Trump, when he was elected 4 years ago, talked about spending $500 billion in new infrastructure over a period of 5 to 10 years. That number is now doubling and tripling, right? Joe Biden and the Democratic Party have talked about over $1 trillion of investment over the next 5 years. And these are incredible numbers. But I'm going to show you in a few slides that it's just a tipping point, right? Just the tip of the iceberg, should I say. So what do we mean? What does this future blueprint look like for infrastructure programs? Universal basic wage, guaranteeing jobs for working for people in water companies, in electricity companies, in networks, so they have a long-term kind of livelihoods, right? Providing, and it's kind of underpinned by the idea that they're going to provide everybody with better housing, better healthcare, better education, more economic security. Think about the rhetoric, right? The world has pivoted. People are now talking, right? You know, you have conservative governments talking almost socialist policies in some ways. They need to employ more people. Look what's happened in the UK. You know, you have a conservative party which has introduced a number of kind of labour reforms, improved and given more state aid to labour, really want to vastly increase the government's influence and government's impact to the lives of people today, right? How's it going to happen? They're going to improve, upgrade current infrastructure, better electricity networks, better gas networks, better water systems, new dams. You think of, and I'm going to show you a slide on water in a minute. It will make it a bit clearer, right? But at the same time, what other things are happening? We've heard so much recently about, you know, reducing pollution, climate change, making sure that we don't go over that 1.5 degrees Celsius that will put the world in a much worse position in the next 10, 20 years. How do we do that? GHG, by the way, my third bullet point, stands for greenhouse gases, right? We heard of all these kind of bad, you know, carbon dioxide, bad GHG emissions. How do we reduce this? We reduce less use of coal, less use of oil, carbon, right? That's one thing. So how do you change the public transport systems? How do you change the utility companies to moving away from using coal or oil to using maybe gas, which is environmentally cleaner than those two, and then encouraging those utility companies to go to hydro, to go into new fuels. So utility companies are not standing still. They may seem like very little is happening from the surface, but they're making billions of dollars of investment so that they have futures. And this is what we mean by sustainable growth. These companies have sustainable business models. They need to do the right things so that they're in existence in 5 years' time, right? In Germany, as you saw a couple of years ago, after some issues in Japan with nuclear power, we're literally saying we're going to switch off nuclear power. A political decision, a populist decision, driving infrastructure spending, right? Because if those nuclear power stations shut down, something has to replace them. So these are stories today that are happening. These are not future things that are happening. These are happening right now, here and now. Right? And so pollutions, what do we mean by smart grid? Right? You might say, well, what is that phrase, AJ? You write at the end of bullet point 3, smart grids. Well, you think about it. A grid system that the electricity grid, let's say, looks at what you're doing and you use electricity, you take electricity. But what about if you have solar power cells on your house? And not only do you take energy, you create it by having solar power. What do you then do with the solar power? What happens to the excess solar power that you've created? You might as well give it to your neighbor or somebody else who needs it, where there's a deficiency. How does that grid network take energy and send it to somewhere else? Right now, the electricity network only works one way. Somebody creates it, it goes down a wire to somebody who needs it. It does not go both ways, right? Smart grids can facilitate that, but that means investment, right? So transport's going to get improved, less emissions, better, moving from diesel power trains to electricity powering all over the world. India, the biggest train, one of the biggest train operators in the world, is transferring. It's going to get rid of all of its diesel engines it has a program to the next 15 years to moving to electricity. That is an enormous venture. So we're seeing enormous growth in clean manufacturing, clean energy, less dirty transport, and we're also trying to get away from pollution in agriculture, fertilizers. If we're not going to use certain things in agriculture, what is the replacement that we can use? What is the infrastructure that we can create that helps with agricultural reform? It's happening all over the world. And the simple phrase is, and Americans have used it, the Europeans have used it, build back better. We're going to rebuild the infrastructure, but we're going to make it better, right? And this is all to do with making a cleaner, more efficient, better world. So I talked about numbers, and I'm going to go through some of these slides a little bit quicker, but it's important to understand what's driving the world. This chart, again, looks a little bit busy, but look at the bar at the bottom. This is the annual amount, so per annum, that the world's been spending on different areas of infrastructure: coal, natural gas, oil, network systems, transmission systems, distribution systems. This is the bar at the bottom, right? And that's what they've been spending over the last 10 years almost, 2010 to 2018, which is a 9-year period. Each year, they were spending just over $1 trillion. And the yellow and the green bars refer to network investment, as in the wires, the poles, the pipes, and the transmission is also about pipes and distribution. And you can see that the yellow and green bars are getting bigger. Now, that was over the last 10 years. If you now look to the next one above, stated policies, if the governments who've made these announcements are doing more green deals, improving their infrastructure, they get their way, we're going to go from about $1 trillion of investment per year to nearly 1.3. But it's going to be more than that, because now that countries are looking at into green energy, green efficiency, making the world cleaner, that could jump to nearly $1.7 trillion per year, right? So we're now looking at enormous increases that need to be financed. David mentioned at the beginning, they need our money, right, to invest in these future investments over time. So I mentioned water to you guys on the group, and I said, let me give you an example of water companies. Now you might think water companies themselves are, right? But that's why I want to use it as an example of creating sustainability. How do these companies look to being more sustainable, right? So if you focus on these kind of numbers in the middle, right? And these talk about like the quality. This is based on research that we've received on how people view UK water, because UK water companies were privatized. They were sold back to the market, right? So the state, i.e. the people, and then they were sold as shares in these companies to operate as independent water companies. And as that's happened, they have improved their quality of service to people. And you can see, from this chart that, the sewerage rate has got much better at 85%. You can see that the energy rate has got better at about 87%, are satisfied, right, with these numbers and what's been happening in terms of supply. But look at the bullet points at the bottom. Customers, and this is from an external report, nearly 2 years old or 3 years old, but this is from a report that we took from a big economic agency. And it talks about the UK water industry, saying customers are now 5 times less likely to experience an unplanned water supply disruption, right? Water companies have reduced leakages by 1/3. Leakages cost the world a valuable resource. Water is a battleground in many parts of the world. If you can reduce the amount of water pipe leakage, dam leakage, that's more the better. That makes your company more sustainable. And if you look at the last bullet point, the water companies are now 64% more productive than they were under nationalization. That was over 20 years ago. 64% more productive. So companies owned by the private sector, more efficient at running their businesses. That's the philosophy. They've proved that. And because they can deliver that, they're allowed to charge customers more over time. Right? And this leads to increased cash flow. If you have something that continues for the long term, you can increase your cash flow. If you have and that means if you can create really good returns, long-term sustainable cash flow, when the banks need to lend you money, and all of these big utility companies still need to borrow money from the banks as long-term loans, right? As well as from the equity markets where we can provide them support. But they still need to borrow money from banks. And the beauty is, if they're a stable, defensive, predictable company, the interest rates that they pay are lower because everybody needs them. They're not going away. So these things help in many ways the evaluation of these companies, and their ESG ratings, environmental, social, and corporate governance ratings. It's a bit of a kind of industry parlance, but it's becoming more and more in vogue with the populations. ESG is becoming more and more interesting. We are getting better ratings for utility companies, for infrastructure companies, because their ESG rating is improving. It has to. People like us, we have a high bar for ESG. We want companies to be well managed, well run, treat their staff well, have less pollution impact to them. If you're an airport, a railroad, a toll road system, you're going to have certain impact. We want to make sure that impact's minimized. They're taking care of both the environment, the people, the population around them. So what outcomes can infrastructure give you? What's in it for you? What's in it for you as an investor, right? And the first thing is, it's a secular growth story. What does this mean, secular? It doesn't matter if we have a boom period or down period in the markets, right? Secular means it's going to happen over a long period of time. Population, urban center growth. In fact, the world needs better infrastructure, right? So this is a long-term, multi-generational story that's going to benefit your kids, their kids in the future. Next, sovereign fiscal constraints. What does that mean? It means the governments can't afford to do it all themselves. Sovereign fiscal constraints. Governments cannot afford to pay all themselves, right? If they try to generate this extra cash, print money, their economies will be impacted in other ways. So if they're trying to run a balanced budget, if they're trying to keep budgets to a certain amount, if they need to invest more into infrastructure, they're going to have to encourage these private companies, these listed companies on the stock market, and pay them well, and they're going to have to come out to us as investors to buy their stock, right? So what's in it for us is that these constraints by the government mean that the access to these companies is going to grow and grow. These infrastructure companies around the world are going to grow in size. There's going to be more of them over time. And that's why having a professional investor like ourselves dedicated to infrastructure investing is really important from the weak companies. That next point is about competition for capital, right? Competition for capital, like there's going to be a few utility companies, a few infrastructure companies that are looking to raise money. So if they're going to raise money, they're going to have to pay you a nice return to get your money. So it's not like, it's a free-for-all. They recognize they have to offer something attractive to you for you to invest long-term. Infrastructure is a driver as well of economic activity. The better the infrastructure in an economy, the better the economic health of that economy, the better it is to move goods and services around the country, the better your education system that you have. So, these are the things that help and underpin an economy, the growth rates, the population growth, and employment. Right now, employment is the key business of governments. And the good thing about the income that you make, the cash flows that you make, the cash flows, the earnings of these companies is often underpinned by regulation or long-term contracts, as I mentioned earlier. That gives you predictability, visibility in what you're going to earn. So for us as investors, when we're looking at the right types of companies to invest in, the companies with more predictability, more visibility in how much they're going to make, more protection in what they're going to make, they're golden tickets for us. And revenues, as I mentioned, are often linked to inflation. And the last point is, what happens to infrastructure companies isn't what happens to a technology company, right? Isn't what happens to a consumer staples company. Let's say, if you are providing, if you're a car business, for example, if nobody's driving and if the population's right now staying at home, the amount of car purchases are going down. Those car companies are being affected. They're laying off people. We don't see that high-low demand in infrastructure companies, which means the companies that we invest in are generally more stable, more predictive. They don't, just because technology companies are doing really well, doesn't mean have to do very well. They might be buoyed by the new iPhone, whatever it is. Essential services that you and I both need. So you then say, well, how do we do it? You got a business called ClearBridge. That's under the Franklin Templeton umbrella. Franklin Templeton, the big company, as David mentioned, we run about $1.4 trillion of your money, assets, all over the world. And one of the investment companies that Franklin Templeton own is a company called ClearBridge, and they have a dedicated team looking at infrastructure. And so they're based both in New York, and I don't need to go through all of these details, but they're based in New York, and they've got an incredible team all over the world, where the infrastructure team business, we run nearly $150 billion of investors' money worldwide. Right? So we are a very well-known house investment company in many places in the world. So we have stability business, we have high levels of risk control and long-term investment discipline. We're a company that's been around for a very long period of time. And the people who run your portfolio, the infrastructure portfolio, this portfolio is a team of 12 people, 12 investment specialists, but the four faces that you see here, senior people of that company, Richard and Nick, that was called Rare Infrastructure. And they were bought effectively by ClearBridge, a predecessor company of ClearBridge, in 2015. They said, we need an infrastructure team. We need one of the best people in the market to deliver infrastructure solutions, investment products to our clients. Who is there? Who is there out on the market? And Richard and Nick had built a really good business called Rare Infrastructure, and it's now part of the ClearBridge business. Shane and Charles, also people with significant amount of experience. Almost everybody in the team, in these four people, have got over 22 years of investment experience. Richard Elmsley has got over nearly 40 years of investment experience. They are all infrastructure people. They live, smell, and breathe infrastructure. And they look at these investment companies in infrastructure assets all over the world. That's what's represented on this slide. A team starting at Richard and Nick, who created the business in 2006, and all the next 10 people, from Shane all the way down to Hoyam Tay. Right? These people, 12 investment people, plus the two traders at the bottom, who conduct the buying and selling of shares on the stock markets all over the world, right? These 12 people really are the intellectual think tank that goes out all over the world to look at the best, highest quality infrastructure companies around that we feel that we can invest in. And we've hired people for this investment team who are dedicated infrastructure specialists. They've worked in regulation. They've worked on the government side. They've worked for research houses on infrastructure. We don't want to just train people as infrastructure. We want them to already come in of being very good infrastructure experts, and then we want them to be trained as being specialist managers. And that's why we say we are infrastructure specialists first, not just a fund manager. We don't do all the other things, right? All we do is infrastructure. And this makes us one of the largest teams in the world dedicated to infrastructure. Our investment process, as you can imagine, is very involved, right? i.e., we spend a lot of time in this disciplined fundamental research. What does that mean, fundamental research? It means we do our homework. We go around the world looking at economic data, making sure we look at the right quality of companies. Are they high quality? How sustainable are their earnings? And that's what this chart is trying to say. These are all the component pieces that we look at, starting from the left, picking the right techniques to evaluate these companies, picking the right stocks to research in the first place. That means universe selection. There's hundreds of companies in the world that look like infrastructure, but most of them aren't worth investing in. So we narrow the world to the universe of companies that we want to research. And we add in the macroeconomic data about what's happening in different parts of the world to make sure we're buying companies where we can see growth developing. And then we do industry analysis, financial analysis, risk analysis. That is what we get paid to do. We build, using smart insights, a portfolio of well-researched companies. And that then takes us to our investment thesis, which is effectively a document saying, why do we like a company? What makes it a good investment for you as an investor in our portfolio? And we look at the returns of the company compared to the risks. That's important, right? Every company has a form of risks, be that regulation risk, be that supply risk, be that up and down economic activity risk. Every company has different types of risk. Our job is to evaluate those risks and to worth it relative to the risk. And remember, these are mainly defensive, stable businesses anyway. But what happens if they're overpriced? Just because a company is great doesn't make it a good investment. It's about balancing those two aspects. And so this is a chart of what we do. It looks quite technical, but we look at the investment thesis. We look at the returns of the company over a 5-year time frame. But to get 5 years worth of research, we need to figure out as much of the future cash flows of that company into the future. And so we use a technique to work out the returns of the company. We call that the internal rate of return. It's a financial metric well understood within the investment industry. But again, it's not important just to see what the returns of a company are. It's important also to understand what the risks of the company are. And what we look at is the real cost of equity. How much do we feel that equity should cost in the first place? The liquidity cost, how much does that stock trade in the stock market? Is it easy to get hold of? Is it difficult to get hold of? Is there a pricing power that has an impact on? And the last factor, sustainability. How sustainable is that company? Does it look good on sustainability? Does it treat its staff well? Does it make an environmental impact? What is the quality of its management? All of these things are considered. And only by looking at those two different aspects can we evaluate a company. So the fund is called the ClearBridge Infrastructure Value Fund, nice and simple. And this is how it looks. When we look at the top 10 stocks, you can see the whole fund has only got 34 companies. 34 companies all over the world. And if you can look at the top 3 or 4 companies, Sempra, for example, is a Californian-based utility company. Union Pacific is one of the big railroad companies of the US. Transurban is a railroad company in Australia. Cheniere Energy is a business in the US. Severn Trent is a water company in the UK. We have lots of diversification, and that's what I want you to look at, the regional and sector exposure. We are globally diversified. We have exposure to multiple different markets, multiple different countries. We have lots of sector exposure, right? So lots of sector exposure to look at. So we don't just invest in one sector, just electric or utilities, but we're looking to get broad exposure, toll roads, right? Rail systems, airports. We want to make sure it's diversified. Why? Because what affects one sector doesn't affect another. What affects one country doesn't affect another. That is how you build a more robust portfolio. And today, the yield of this portfolio, like if you look at all the different companies that we own, the 34 companies, their average dividend, the income that they pay out, is just about nearly 3%, right? And these companies are large, right? These companies, on average, have an average market cap. The average size of them on the stock market is about $29 billion. We're not buying small businesses. We're buying shares in high quality, large quality businesses around the world. So in conclusion, right, I'm at the 50-minute mark, pretty much, 48 minutes. So David will want it back in a minute. But this is my conclusion. We have created a fabulous long-term infrastructure fund. We've been managing this fund for over 10 years. It is the flagship fund of the infrastructure team, and it's very well managed, got high quality long-term returns. We believe the future for infrastructure is very attractive. In the short term, the COVID-19 response by governments and corporates means that they're going to invest more in infrastructure. They'll want to invest more to employ more people, to make the economy better. But the climate change impact, that's the long-term impact. We need climate change infrastructure investments. We need to build better utility companies, greener utility companies, greener networks. And so it's not just for investors, it's for the customers, right? You and I, as users of that energy, users of those public transport systems, want better, cleaner, more efficient systems. And that has a massive impact. So massive infrastructure investment. Governments can't do it all themselves. They need our money. The private sector will build it and they'll charge an attractive return for it. This is a growing set of companies, but we're only interested in investing in the best, highest quality businesses around the world. And this will lead to a better world for us, our children, and future generations. Our portfolio is expertly managed, investing in some of those high quality businesses around the world. Thank you very much for your time. And I'm going to pass it back to David. I hope that was good insights for you. And I look forward to seeing you one day in person to talk about this in more detail. But for now, I'll hand you back to David and Ingrid.
Thank you very much, Ajay. Thank you. Yes, indeed. Thank you for that stimulating presentation. As guests, I hope you find it interesting and informative. Hopefully you'll agree with us that infrastructure companies offer a very exciting investment opportunity, not only to provide you with sustainable income, but also to provide you with capital growth over time. If you would like more information on this subject or have any questions, please contact your usual MeDirect contact and they will be delighted to help you. All that remains for me to say is to thank you for joining us this evening. Thanks to Ajay for the presentation, and I hope you all stay safe and well during this awful pandemic we are all living through. I will now hand you over to Ingrid for closing remarks. Thank you.
David and Ajay, thank you for your time today and for all the information you provided. I am sure we all found it very fruitful. I would also like to thank the team at Franklin Templeton who worked to make this possible. May I also take the opportunity to wish Ajay a happy birthday. I know that today is his birthday and he made an effort to be with us today. A big thank you also goes to all of you who have joined us today. Our team of advisors are available if you have any questions. Further information on the funds discussed can also be found on our website, www.medirect.com.mt. Thank you once again and stay safe, everyone.